Good morning, everybody. Mike Vaki, Princetontrader.com, here for ntmarkets.com with your Monday morning pre-market webcast. Okay, S&P 500 E-mini futures. This is a daily chart, and what we saw on Friday was a positive reaction to the jobs report. Whether it was, bad news, good reaction, whatever you want to call it, we went higher. We solidified last week's weekly pivot as well as the middle band, both in the 2097 area as support once again. Did not make a new high relative to this high at 2115 or the high up at 1975. So really the only thing left for the bulls to overcome at this point are the highs. They want to stop making a series of lower highs, and they also want to break out of this little 2-day cycle that we've been seeing. 2 days up, 2 days down, couple days up, down, up. And this is indicative of what I've been talking about with respect to a two-sided market. The fact that the 2013 straight bull uptrend that, carried itself into much of 2014, that ended back in October when we went down to 1813 to 1815 and violated the 200-day exponential moving average. That was kind of the shock to the system to get out of that straight macro uptrend, every day is a dip buy kind of a deal. Doesn't mean that it's turned into a bear market. Quite the opposite. But what we're seeing is the bulls have their moments and the bears have their moments. So you get in a trade, take your money, you leave a runner on, and you start looking in the other direction. It's very much a trader's market. It's not a market where you can really hold long for extended periods of time or hold short for extended periods of time. It's going to whip you out. And, if you take a look back, at any point here, any kind of a hold, you fluctuated between, doing okay and being red at any point in time. And right now we're back near the highs. Could we do another leg up? Yes, we could. And it's becoming ripe for that scenario. If the bulls can follow through, if the bulls can make new highs, what they have going on in their favor are these tight bands. Bollinger Bandwidth comes in at 2.17 today. Those are tight. Let me back out the chart. They're not as tight as they've ever been, but they're pretty tight. They're pretty similar to here. They're actually a little bit tighter than back in December when we went on that ride. They're not quite as tight as the September into October move down to 1813, but they're getting there. And the more we head fake around, the more we engage the middle band, the tighter they will become. So one of two things. Could we begin some kind of a band ride this week? Absolutely. Absolutely could. Could we instead, could this just be another, couple day head fake type of a move? Yes, absolutely. That is equally plausible. And if that happens, then you'll see the bands become even tighter, and that lends itself to an even bigger expansion push when those bands are ready to go. So coming into today, I want to see what happens in the regular session. Are we going to get a morning high? Are we going to get a morning low? The dip buyers will come in. The dip buyers will come in, and the bears will have to fight them off. The issue becomes, can the bears start to create lower lows headed into the lunch period? If they can, I've got a lot of support down in the 93 to 95 area. A move down to 93, 95 may be, the kind of a test to begin the week that could, if the bulls can hold it, could start another leg up. If that area breaks and you see 93 to 95 go resistance, then it's more of the same. Then we're going to get ready for a couple of red days. 2 red, 2 green, 2 red, 2 green. So the ball's in the bull's court to break that pattern. Okay, everybody have a fantastic day. Follow us on Twitter at Princeton Trader. Come check out the website, Princetontrader.com. Come check out the chat room. I'll be back tomorrow morning with another webcast. Trade 'em well, everybody.